Hi traders, and welcome to the next video in this course where we're going to be taking a look at scenario analysis for economic data reports. Now, we know that central banks and monetary policy are very important for us as traders, especially because we trade based on the fundamentals. That's our main form of analysis. That's how we decide what we're going to trade and what direction we're going to trade in, and then we use the technicals after that to plan that trade and decide where to execute, where to place the stop loss and take profit, and so on. Now, the economic data is going to dictate what the central banks do with monetary policy, and one of the things we've talked about is the markets are forward-looking. They are going to try and predict what central banks will do with monetary policy rather than waiting to get to the meeting and seeing the central bank doing it. If you have a pretty good idea of what the central bank is going to do, why would you not start to prepare for it right now? And the central banks like this as well, because it means that there's going to be less volatility than there would be otherwise. When you get to central bank meetings, there is usually volatile movements, but it could be a lot more volatile had the markets not already been pricing in certain situations. So what we'll do in this video, like we did with the last one, is we'll start off with a short list of the steps that you need to take to prepare for an economic report. So this could be anything like a jobs report, it could be CPI, it could be the GDP report, anything which is of relevance to the markets. And that's really the first step. Assess how important the report will be for the central bank. Now, when we get to the next section of this course, which will be the last one, as I said in the last video, we'll look at how to piece a lot of this information together. And part of that will be learning about some of the tools that we use. Now, what we do as traders is there's a lot of economic calendars out there. And we'll use these economic calendars to just see what's coming up over the next week or two that we need to be aware of. Is there a CPI report for a certain country? Is there maybe a jobs report? We can look at the calendar and find that out. So once you've done that, you now need to basically say, okay, which of these reports are important? What we did in the last video is we looked at preparing for a central bank meeting. And one of the key parts of that is when we went through the policy statement, looking at what areas of the economy are the central bank focused on. That's going to dictate what areas you need to focus on, what data do you need to focus on. So we'll see in a moment with an example what sort of data we should be looking at. But if we go to the last video and the example there, at the Bank of Canada were looking at consumer spending, so that meant retail sales was important. They were looking at investment and they were looking at housing. So those were the areas that we needed to focus on, and they also had the geopolitical risk with the trade war. So from the central bank's most recent statement, you'll have an idea of what data you need to be focused on and what data is not that relevant. A lot of data on the calendars gets either marked as high importance or low importance, but it's not consistently going to be the same. There's times where certain data like the labor market data could be much more important than CPI, even though CPI is typically, or inflation is typically, a central bank's mandate. Sometimes it could be that some of the low impact data that you don't normally focus on all of a sudden starts to come into focus. So don't get misled by what you're seeing on the calendar. You've got to figure out for yourself which data points are most important to focus on. So that's the first step. The second step is once you figured out that, okay, these are the reports that are important, these are the ones where I might get a tradable opportunity, you need to use multiple calendars to check the forecasts for the reports. So with an economic calendar, as I said, again, we're going to go through this in the next section. I'll show you some of the tools that we use and some of the calendars we use. But on a calendar, you're going to get information about, firstly, what is the description of the release? What is it showing? Is it the unemployment rate? Is it the employment change? Is it CPI month on month or year on year? That's the first piece of information you'll get. Then you get the previous reading, and then you get a forecast. And then once you get to the actual date of the release, you'll get the most recent number. Now, when it comes to the forecasts, there's different ways that these get put together. So what someone like Bloomberg or Refinitiv will do, they're two of the biggest names when it comes to economic data in finance. They'll send out their surveys to multiple banks or hedge funds. So they could send a survey to, let's say, Goldman Sachs, Citibank, Morgan Stanley, JP Morgan, and so on. And they'll ask them, okay, we've got this report coming up. What are your projections for the readings here? They get all of these numbers back from these various banks. And what you see on your screen is going to be the median forecast of this range of data that they have. So those are the numbers you normally see. Now, Refinitiv's numbers, their forecast might be slightly different to the Bloomberg ones because they've asked some different people. Now, other calendars might decide to, they'll go to various sources as well that they can get their hands on and compile the data in a similar manner. So the reason why it's important to check multiple calendars is because of that variation that you could potentially get. So the three calendars that I use, and I will go through this again in the last section, but the ones I use are Forex Factory, Investing.com, and MyFXbook. And usually if you've got those three, then you've pretty much got what you need out of them. So once you've checked the forecasts, you know what the sort of range of numbers are that you're looking at. Because let's say Forex Factory, for the unemployment rate, they are forecasting 4%. And then let's say MyFXbook is forecasting 4.1. Now, if you're just looking at the Forex Factory calendar and you get a reading of 4.1, you're going to think that this is worse than expected. So the markets may react negatively to this. And then you look at the charts and you don't see any reaction. And it could be because the MyFXbook one has 4.1, which meant that even though it wasn't on Forex Factory, there were a decent amount of people expecting that number. So it wasn't actually too surprising for the markets. This is the main reason why we use multiple calendars. The next thing you want to do is you want to read through multiple banknotes. So this is analysis released from investment banks, which is usually done on a regular basis. Some will release it weekly. Some will release analysis daily for different markets. Some will be a little bit more, a little less frequent. They could be once a month, once a quarter. But the ones that release it frequently, you want to keep an eye on those. Now, banknotes are a little bit difficult to get a hold of for retail traders, but there's a website called fxstreet.com. Again, I'll go through this a little bit more in the next section. But on there, what they do is any banknotes they can get a hold of, they sort of strip out the 2 or 3 key paragraphs that are in there that are related to the FX markets. Whether that's the forecast for a certain pair or whether it's a forecast for a central bank or economic data. They'll get that and then they'll publish it on their website. So that's one of the ways that you can get access to what the banks are saying, because the main thing we're looking for is not to read through the entire banknote. We just want to know what these different banks are forecasting. Now, that should be done within the calendars, but on the calendars, we can't see which banks have been questioned. So rather than just seeing the median number, we start to build a bit more data up, and we can see what different banks are specifically forecasting for that event. So you maybe want to try and get a hold of about 3-4, as many as you can, but about 3-4 is pretty good. And what you want to do is, again, similar to what I said with step 2, you want to sort of just make sure you've made a note of this and try and gauge where these different forecasts are in relation to what you're seeing as the median forecast on the calendars. Because again, if you had, let's say, Forex Factory is predicting an unemployment rate, they're showing a forecast of 4%. But then you look at Goldman Sachs and you see Citibank and they're both forecasting 4.2. And then you see, let's say, Morgan Stanley forecasting 3.9. Now, the more data you have, the better it is, but it is difficult to get a hold of. So that's why I said just if you can get 3 to 4, it's fine. But in this example, if you now come in at 4.2, it doesn't look great. If you look at the calendar, it doesn't look great, but you did have two big banks predicting that number. And if you had other banks also predicting that number, then the deviation there or the number there hasn't really surprised the markets too much. So again, are you likely to see a movement? Now, one of the things that we used to previously be able to get a hold of was the full range of data from Refinitiv. So you'd see the lowest prediction, the highest prediction, and then the forecast would be the median. And you could see how many different numbers were there. So you could, from that, you could tell which numbers you really had to look out for. So if you were seeing 4% on the calendar, but then you knew that quite a few banks are also forecasting 4.2, you knew that you need to see a number higher than 4.2 for it to really surprise the markets. And it could be something similar on the downside. So this is why it's important to go through the banknotes as well. What you also want to do when you go through these banknotes is just check whether, especially when you get to the week of the release, is check whether the banks have changed their forecasts from what they might have been just a week or two ago, because that does happen from time to time under very volatile conditions. When the economic data and the market conditions are very sensitive and volatile, you'll see banks changing their forecasts just a few days before the release. And that's quite important because, again, if these calendars haven't updated their data, so if they're still showing, let's say, 4% unemployment, but a lot of these banks have updated their forecasts and they're now saying that, you know what, we're actually expecting 4.1%, then that's really the key number you need to look out for. So most of the time, the calendar is pretty accurate, but there are times where you need to be aware of some of this other information as well. And it's just a good habit to do it on a regular basis so you don't, firstly, you don't forget it. And also it doesn't create that much extra work for you at the times where it's more necessary to do it. So that's step number 3. Step 4 is you want to assess the market pricing for the corresponding central bank. So if we're getting the jobs data for, let's say, Canada, what is the market pricing in for the Bank of Canada? What are they expecting at the next meeting? Are they expecting a hike? Are they expecting a cut? Are they expecting them to remain the same? And then linking it back to step 1, how important is this data going to be for the central bank? What will it do if it comes in higher or lower? Or sometimes even as expected. That could sometimes just confirm that the central bank is going to do maybe a rate hike. So you want to look at the market pricing. The main way you sort of do that is similar to what we said in the last video. You go through those same sort of steps to figure out what is the central bank looking at, what are their forecasts, what have they indicated for the upcoming meetings. And the final step is determine what assets you're going to trade. So again, very similar to the central bank scenario analysis. When it comes to economic data, you pretty much have 3 branches that you're going to get for the release. One will be the data comes in as expected. The other will be that the data comes in higher, and then the third one will be the data comes in lower. Now, out of those, you could have, out of the higher and lower ones, you could have another 2 branches. So one could be that it comes in higher, but only slightly. So it might just be by, let's say we're looking at a percentage. And if we stick with the unemployment rate example, then if it comes in, we're expecting 4%. If it comes in at 4.2 or below, but higher than expected, so 4.1 and 4.2%, this is what you're going to do. If it comes in higher than 4.2, then this is what you're going to do. And the same thing for the lower side if you miss the expectations. And when you pick what assets you want to trade, it's all going to be dependent on what do you expect this to change for the central bank. Do you think they're going to now hike or cut rates? And depending on which way they're going to go, what are the best FX pairs to choose? What are the best bonds to use? Normally, you probably want to use shorter term bonds when it comes to trading rather than longer term. If you're going to trade any commodities, is it going to impact any commodities? Usually it won't, but from time to time, you never know. And then lastly, the equity indices, you want to take a look at that as well. Now, another key thing to keep in mind is we're talking about this guideline is sort of based on we're looking at one single reading. What often happens though is you get a headline number, but then you get all of these other subcomponents. So sometimes you get the headline number, which could be year on year, but then you get the headline month on month. You get the core year on year. You get the core month on month. If you're looking at inflation, or with the jobs data, you get unemployment rate. You get the employment change. You get the wages data. So your scenario analysis then needs to be a little bit more detailed. If we come in, let's say with the unemployment rate, if we come in higher than expected, but the participation rate has gone up as well, then that maybe explains why the unemployment rate's gone up. So it's actually not too concerning. If you have, let's say with inflation, if the year-on-year number goes up, but other readings haven't changed too much, then that could indicate that maybe there's some base effects in play. So again, it might not be too concerning. Sometimes it could be that the main number, the headline number, looks pretty decent. It's not anything to worry about, but then the subcomponents have maybe gone up or down. And that's maybe more important to look at. So you've also got to, when you figure out how important the report's going to be, you also need to have a think about how important will each component of the report be. And once you get to the release, something which I always tell all of our trainees is, on the calendar, you see the numbers. That's all you get, just the numbers. But all of these reports come with, we call them economic reports, because they come with an actual report. So it's not just numbers, there's some analysis and some description with those numbers that can explain it a little bit further. So what you also need to get into the habit of doing is making sure you read the actual report when it comes out. Don't just rely on the numbers, because the numbers aren't always going to tell you the full story. So that's another important part, but that's after the data comes out. Right now, we're talking about how to prepare for the event. So these are the main steps you need to take. Now, like we did in the last video, I'm just going to go through a very, very simple example of how this would work. So for this, I'm going to use the Bank of England. And the Bank of England had a meeting on 4th of November 2021. And I've copied and pasted this small sentence out of their policy statement. The committee judges that provided the incoming data, particularly on the labour market, are broadly in line with the central projections in the November monetary policy report. It will be necessary over the coming months to increase the bank rate in order to return CPI inflation sustainably to the 2% target. Now, to just give a little bit of background on this. So in 2021, what we were seeing is inflation around the world was going above target. Inflation was high. A lot of central banks felt like it's because of supply chain issues, so it should naturally come back down. But CPI continued to go up, and it started to get a bit uncomfortable for the central banks. So then they had to start looking at hiking rates just to see whether they could try and weaken the demand side a little bit and bring inflation under control. Now, one of the things that we see here from the Bank of England is they put a lot of emphasis on the labour market. And a lot of central banks were looking at the labour market because if the labour market continued to tighten, it would push wages higher, which would feed into demand, which would then feed into inflation. So what this sentence here tells us is we need to pay a lot of attention to the next labour market report that we get. They also talk about the projections they made in their November report. So if I just bring up that November report, what we can see here is on the unemployment rate, the forecast for Q4 2021 is 4.5%, which has been improved a little bit from what they had previously. For 2022, they expect that number to fall towards 4%. The other numbers don't really matter too much right now. So 4.5% is the number to keep in mind, and 4% for the end of 2022. That's what the central bank are expecting. So they said if the labor market data continues in line with these projections, then rate hikes will be warranted. So that's what we've had there. Now, if we move to the next slide, the next labor market report that we had was on 14th of December. So what have we got here? The employment change came in at 149k. So 149,000 jobs were added, but this was below the expected 228k and slower than the previous 247k. The claimant count change, which is the number of people claiming employment benefits, that dropped. Earnings pushed up. So we hit 4.9 here versus the expected 4.6 and 4.3 here versus the 4.0% expected. And the unemployment rate came in at 4.2. That is better than the 4.3 we had previously. Now, again, this is in line with expectations, but it's better than what the central bank had been projecting. They were looking at 4.5 for the end of that quarter, and we were in December. So this was basically the final reading for that quarter, and the unemployment rate was at 4.2%. So we were doing a lot better than expected, and they were expecting 4% for the following year. But with these sorts of numbers, you're probably looking at that and saying that we've already improved from 4.3 to 4.2. We could very easily go below 4% the following year. And the other thing I mentioned is the reason why central banks were watching jobs is because if there's low unemployment and the labor market's tight, it means that wages are going to go up, which you can see here. Wage growth is accelerating. If that accelerates, that's going to feed into demand, which then feeds into inflation. So when we got this report, we said, okay, this basically confirms that the central bank is going to pull the trigger and do a rate hike at the next meeting. So the next meeting was on something like 16th of December. Now, along with that jobs report, we also had two inflation reports, which were pretty good. One of those inflation reports was just the day before the second Bank of England meeting, and it was a very strong report. Not that we really needed to see that for to basically say that the Bank of England is going to pull the trigger. Now, this was the first Bank of England report, the one where we looked at that sentence where they put emphasis on the labour market. And we can see here that the pound here, this is the pound dollar, the pound fell after that meeting. Now, the reason why is because the markets were actually expecting that the central bank would have gone and hiked at this meeting, but they didn't. So we saw a decline, and that continued. We then got to the jobs report, and one of the other things that before I go on, that the markets were worried about is when the central bank didn't hike here, the markets feared that they'd lost the correct window of opportunity where they could have hiked rates and justified it as well. So when the market saw that, we just saw a continued decline in the pound. We then get to the jobs report, which we've just looked at. That comes in and you start to see a bit of upside. So when you did your scenario analysis, what you would have probably said is if the unemployment rate comes in as expected or better than expected, you're going to go long on the pound. You might have also said that if the if wages come in better than expected as well, that's going to add conviction to that trade. So you might have then decided, I'm going to take a little bit more risk on that trade, or I'm going to hold that position for longer. That's something else that could come into play in your scenario analysis. How long do you hold it? How tight do you keep your stop loss? Are you going to give it a lot of room to breathe? Now, in this situation, everything pretty much lined up for a very nice trade. So you could have said, you know what, I'm going to keep the stop loss wide and I'm going to hold this trade into that Bank of England meeting. We had a bit of choppiness, but once we got to that meeting, we saw a further rally. Now, after that, we saw a decline. Now, we don't know exactly what factors were in play here, but one of the things that could have happened is you've got a lot of traders who have done their scenario analysis. They've planned what they're going to do. They've basically gone long here, held into that meeting, taken their profits. That trade's played out exactly as you're expecting. They took the profits, which has triggered this move to the downside. And that's then allowed the opportunity for other people who didn't get in here to go long again, to come in and buy the pound. Another factor that could have been in play is, as I said here, people felt like the Bank of England lost their opportunity. But once they saw the jobs report, once they then saw the inflation data that also came out, they said that actually, no, the Bank of England will need to do multiple rate hikes. And we can see we had a fair bit of a rally, pretty much got back all of these losses. So that would have been a very nice trade there as well. So again, that could be a part of your scenario analysis. How long do you want to hold that trade? Do you want to take some profits in the short term? And then do you want to look to go long again? Do you want to just take profit somewhere around here and then say you're done with that trade? Do you want to keep holding it? All of these things come into play in your scenario analysis. Like I said with the last video, and I'll say it with this one, the steps I've given you, they are just a foundation. You're going to have to adjust it and add more detail to it, depending on what the report is, depending on what the central bank meeting is, depending on what the situation in the markets is. There's always multiple factors you've got to take into consideration. So that's what we had there with the Bank of England and that jobs report. Now, as I said, the other thing you've always got to do is make sure you go and read the report. And the reason why is because that can give you a little bit more information. This is something you'll gain with experience. And I've purposely chosen this example here because whilst it's played out fairly nicely over the long run, there was a lot of choppiness in between. And like we said with technical analysis or central bank meetings, in the markets, things don't always play out very cleanly. And having these plans in place help you to maintain some sort of discipline. So, for example, when you saw this downside, if you didn't have a plan, you might have panicked and closed the trade. If you had a plan, you would have said, no, I'm sticking to the plan. I'm going to hold this into the central bank meeting because everything is lined up for this trade. There's no reason to be closing it. And then, of course, that would have paid off. There'll be times where it doesn't pay off. That happens in the markets as well. But the key thing is the markets won't always play out very cleanly. So you do need to have that discipline and that patience. Now, when it comes to the economic reports, as I've said, they give you a little bit more color on the numbers. They tell you some more information that the numbers might not give you. For example, we were in December. This report was for December. So the report might have said jobs growth was fairly strong, the unemployment rate improved, and wage growth improved. But a big reason for that was holiday hiring. Businesses hiring for the holiday period, which means that those would be temporary jobs and we'd probably lose them early in the new year. In which case, you then question, is this trade actually warranted? And it may not be. Alternatively, you might have looked at it and said, okay, fine, it takes some of the conviction out of the trade, but the Bank of England are still very likely to go and hike at this meeting, so you might have held the trade. And that conviction could dictate how tight you keep the stop loss, how big you keep your position size, how much risk do you take, and how long do you keep holding that trade after the meeting. So this is why it's important to go and read the report as well. And it's very easy to find. when we go through one of the videos in the next section, Forex Factory, they provide a very easy way for us to get access to the reports, a simple link from their calendar, and we can see the full report. But we'll go through that in the next section. That now brings us to the end of this video, and this is the final video for this section. So thank you all for watching, and as I've said in this video and the last one, if a lot of these things feel like they're a little bit all over the place and they don't make sense, don't worry about it. Right now, we're just giving you the key tools that you need and the information. In the next section, we're going to start looking at how to basically put it all together. How do you start to build a trade plan? What should your general trading routine look like? That will all be covered in the next section of the course. So once again, thank you for watching and see you in the next section. Cheers.